Welcome to today's video on why portfolio simplicity usually beats complexity for long-term wealth building. We'll walk through how to rebuild after pulling funds to handle debt, how to structure an aggressive growth portfolio without unnecessary overlap, and how to right-size your international exposure. We'll also cover pitfalls like dividend myths, speculative sleeves such as crypto and swing trading, and a clean step-by-step rebuild plan. To keep this smooth, we'll transition clearly between sections and test your knowledge with quick quizzes along the way. Here's our roadmap. First, we discuss why simplicity wins. Next, we unpack overlapping funds and the uncompensated risk they introduce. Then, we get into the total market strategy using VTI and VXUS, including the importance of increasing international exposure into the 30 to 40% range. After that, we'll avoid the ETF mess in taxable accounts and address dividend myths. We will then frame a prudent approach to speculative allocations like crypto and swing trading. Finally, we end with a step-by-step rebuild plan and quick quizzes to reinforce learning. This content is educational and not financial advice. Investing involves risk, including potential loss of principal. Past performance does not guarantee future results. Tax situations vary. Before acting on anything here, consult a licensed financial professional and consider your personal circumstances. With that clarified, let's proceed to the core ideas. Overlapping growth ETFs often hold the same top names already contained within total market funds. By stacking QQQ, VGT, VUG, or IWF on top of a broad U.S. fund like VTI, you frequently end up paying multiple expense ratios for essentially the same underlying stocks. That introduces uncompensated risk because it increases concentration and volatility without increasing expected market returns compared to owning the broad market itself. Therefore, shifting toward a simpler core reduces redundancy and better aligns risk with expected return. Next, let's compare simple versus complex portfolios directly. On the left, a simple portfolio relies on 1 to 3 broad funds, such as a total U.S. market fund and a total international fund. This structure features lower fees, minimal overlap, broad diversification, and straightforward rebalancing. On the right, a complex portfolio combines many growth and dividend ETFs that frequently hold the same companies. This increases cost and redundancy, complicates rebalancing, and can nudge the portfolio away from its intended risk and return profile. With that in mind, let's outline a clean total market strategy. A highly efficient core for aggressive, long-term growth is a broad U.S. total market fund paired with a broad international fund. A practical target is 30 to 40% of equities in international markets to balance the historical cycles of outperformance between the U.S. and foreign equities. This approach owns the global market rather than making short-term sector bets. To manage risk and maintain alignment with your goals, schedule rebalancing at set intervals and avoid reacting to headlines. Next, let's translate this into model allocations by account type. Here are sample models. In a Roth IRA aiming for aggressive growth, 70% VTI and 30% VXUS is a clean core mix. In a simple aggressive taxable account, 65% VTI and 35% VXUS keeps things straightforward. If you choose to include a high-risk sleeve in taxable, one example is 55% VTI, 25% VXUS, and 20% speculative, split across crypto and swing trading. This is optional and high risk. Always ensure the core dominates and that you understand the risks of speculative positions. Now, let's address dividend myths that often add unnecessary complexity. Dividends are not free money. They are distributions from company cash that lower the company's value by the amount paid. Dividend-focused funds often tilt toward value, which can conflict with a mandate for aggressive growth. Yield chasing can also increase concentration and, in taxable accounts, potentially increase your tax drag. If your goal is high long-term growth with broad exposure, a simple total market approach is typically more consistent with that objective. Next, let's visualize how cycles of outperformance alternate between the U.S. and international markets. This timeline illustrates alternating cycles of outperformance between U.S. and international equities from the 1970s through the 2020s. The key takeaway is that leadership rotates. By holding 30 to 40% in international markets, you reduce reliance on a single region's dominance and potentially smooth your ride over time. With that context, let's turn to a step-by-step plan to rebuild your portfolio. Follow a clear sequence. First, address high-interest debt to stabilize your cash flow. Next, maximize contributions to tax-advantaged accounts, such as a Roth IRA or workplace plans. Then, build your core using a total U.S. market fund and a total international fund, with 30 to 40% allocated internationally. Avoid redundant growth or dividend funds that duplicate exposure. Establish a rebalancing schedule, for example quarterly or semi-annually. In taxable accounts, prefer broad funds instead of themed tilts to minimize complexity and tax drag. If you choose a speculative sleeve, cap it and implement predefined rules. For crypto, rely on reputable exchanges for transacting and store core holdings in a cold wallet. Finally, write an investment policy statement to keep decisions consistent through market swings. Now let's reinforce these principles with a mind map of simplicity pillars. This mind map highlights the pillars of a simple strategy: broad ownership across the U.S. and international markets, attention to low costs and minimal redundancy, disciplined rebalancing, and clear documentation to guide behavior. An optional speculative sleeve is separate and contained, with crypto core assets stored via cold storage. With these pillars in mind, let's check your understanding with a quick quiz. Question: if you already hold VTI for total U.S. exposure, what is the most likely effect of adding QQQ, VGT, or VUG on top? Options: A. Higher expected market returns with the same volatility. B. Lower fees due to diversification. C. More concentration and overlap without higher expected market returns. D. Guaranteed outperformance versus the market. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C. Adding growth-heavy ETFs to a total market position usually increases concentration and overlap. This raises volatility, but typically does not increase expected market returns. Now let's move to international exposure. Question: for global diversification, which international equity allocation range best balances historical leadership cycles? Options: A. 5 to 10%, B. 10 to 15%, C. 30 to 40%, D. 60 to 80%. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C. 30 to 40%. This range has historically helped balance the alternating leadership cycles between U.S. and international equities. Next, let's separate the core portfolio from a speculative sleeve. Treat speculation as a separate sleeve with explicit limits. For example, cap crypto at around 10%, and swing trading at a defined upper bound such as 25% if you truly have high risk tolerance. Store core crypto holdings in a cold wallet for security. Use written rules for entries, exits, sizing, and risk controls to avoid impulsive decisions. Most importantly, ensure speculation never overwhelms the broad, diversified core. Now let's consolidate our key takeaways. These are the core takeaways. Keep portfolios simple and broad. Avoid overlapping funds that add risk without raising expected return. Increase international exposure into the 30 to 40% range. In taxable accounts, favor broad index funds to avoid unnecessary complexity. If you include speculative assets, cap the size, and secure crypto in cold storage. Rebalance on a schedule and follow a documented plan. Next, a quick markdown recap for reference. Here is a concise recap using markdown styling. The core is a total U.S. market fund, plus a total international fund, with 30 to 40% allocated internationally. Avoid stacking redundant growth funds on top of a total market holding. In taxable accounts, broad funds are generally preferable to themed tilts to reduce churn and tax drag. For speculative positions, keep crypto around 10% with cold storage and cap swing trading based on predefined rules. Finally, set a rebalancing cadence and document your policy to maintain consistency. To conclude, simplicity tends to scale while complexity can compound mistakes. Global diversification is a feature that balances cycles, not a flaw to be corrected. A repeatable process beats prediction over the long run. As you move forward, keep your portfolio aligned with your goals using broad index funds, disciplined rebalancing, and clearly defined rules for any speculative sleeve. Thanks for watching. If this video helped you, please like, share, and subscribe for more simple investing content. Share your allocation and any lessons you have learned in the comments, to help others on their journey.